Welcome to the Transparent FX Academy. I'm Nick and I'm a top odds on trading with over 190k reputation points.
In this video, I will be speaking about how to trade Forex market manipulations. Now, as usual, I will be proceeding by steps. So first, we will be speaking about what manipulations are. Then we will be speaking about why the market is manipulated. Then we will be speaking about how to spot a manipulation using also the order flow. So essentially, what institutions are doing in the market by reading the commitment of traders, so the COT data. And then as the last point, we will be speaking about how to potentially take advantage of these manipulations. So it will be a very interesting video. I suggest to stick to it till the end. And without further ado, let's get straight into it. Okay, so first of all, let's speak about what manipulations are. So essentially, to put it in very simple terms, a manipulation is when the market creates a movement to the opposite side of the official trend, creating such movement without any specific reason to the overall direction of the trend. So essentially, if you have a bullish trend, the market, in theory, even in an ideal uptrend, you essentially would have a market which is creating higher highs and higher lows. And every time in an ideal uptrend, you would have a market that every time goes and retests exactly the previous resistance turn support, because as you know, in the market, previous resistance, once it is broken to the upside, so essentially when you have an impulse and correction, this is the previous resistance. The market then breaks above it. That previous resistance is supposed to be turned support. The market then is supposed to go and retest that previous resistance turn support, reject it to the upside, at that point breaking above the previous high, which is previous resistance, which at that point becomes support. The market then is supposed to go and retest it and reject to the upside, and so on and so forth. So essentially in an ideal uptrend, this is the situation that you would expect, right? That is what you find in textbooks. However, it is important to notice that in real markets, that is not how usually the market tends to essentially create an uptrend. It's not just a series of higher highs and higher lows in which every single time you have the retest of the previous resistance turn support, right? You have several movements, and overall, yes, the market is creating higher highs and higher lows, but this is similarly more what the market will actually look like in an uptrend. You will have a lot more swings and a lot more manipulations, because during this move to the upside, you will have several times in which the market fakes the move to the upside, then creates a move lower, and only at that point creates the move to the upside. That is essentially a manipulation. So a movement that is different from what you would usually expect in an ideal uptrend. So that is what a manipulation is. Now, those movements that are not what an ideal uptrend would do essentially create huge amount of stop triggering, so stop loss triggering, especially for retail traders. Now, let's go immediately into a more specific example of this topic. So as I said just previously, an ideal uptrend is a series of higher highs and higher lows, right? So anything that is different from this essentially would be a manipulation. So here, for example, you have a clear impulse to the upside. What you would expect is a correction and then the continuation to the upside. And then the market will essentially continue like this every time, going and retesting the previous resistance turn support. In this case, the previous high is here, right? You have 1, 2, then you would expect 1, 2, 3, right? That is what you would expect in an ideal trend. So let's see if that is what happens. So we have the move to the upside, correction, continuation higher. Now we would expect the retest of this previous high and then the continuation to the upside, right? However, what the market creates here is first, it fakes the fact that it has in fact been moving in an ideal trend. And after that, this is exactly what you would expect. From here, you would expect the move higher, correction, and continuation higher. However, what actually happens is that we have this move to the downside, right? The market from here creates this move to the downside. And only at that point, after this manipulation, only at that point, the market is essentially continuing higher, as we can see that it is currently doing. So why did the market create this move to the downside? Okay, why did it create this manipulation? So essentially, what and why the market is manipulated. So what manipulations are, we just covered it. Now, why is the market manipulated? Because, as you know, in the market, there are big institutions and big players in the market that have huge orders. Now, if they want to buy and essentially execute a long position, at any specific time, there isn't enough liquidity for them to just press the button as you would as a retail trader and execute your order, right? Because as you know, in the market, for every buyer, there needs to be a seller. For every seller, there needs to be a buyer. At any specific moment in the market, if you're looking to buy a huge amount, there might not be enough selling pressure, so there might not be enough sellers that will sell whatever it is that you're buying, in this case USD JPY. So in that specific situation, what market makers and these big institutions will do is essentially they will manipulate the market in order to create that artificial selling pressure. Now, the way in which they do that is by creating these manipulations, which are stop hunts. Because what we know in the market is that what you essentially read right in textbooks when you're starting to trade and what potentially you're already doing is when you're looking for a long, okay, let's say most traders, when they see a candle like this, especially on the daily time frame, they will be looking for a potential long because this is a pin bar. So essentially, they would be looking for a long and their stop loss would most likely be below the low, right? That is what most people teach, that your stop loss is supposed to be below the low. So what market makers and institutions that are looking to manipulate the market and trigger those stop losses will do, they will create a move to the downside that goes and tests those prices where a massive cluster of stop losses is most likely placed. And at that point, all that selling pressure that comes from the stop losses is used to actually buy and fill in their orders. And only at that point, the move to the upside can actually start, because it is important to point out that if you're longing and you have a stop loss, the stop loss is simply a sell order. So by triggering your stop loss, they're actually creating selling pressure, because the stop loss, if you bought, is simply a sell order. So it is creating that selling pressure that they need in order to activate their longs and have enough sellers in the market to actually buy the quantity that they're looking to buy. So that is why manipulations are created. Now, the second question, actually the third question, would be how to spot these manipulations beforehand, right? So if you have this move to the downside, how do you know that this is actually a manipulation? And from here, you have a good probability of a move higher. And instead of this being just the end of an uptrend and the shift to a downtrend, well, an easy trick that you can use is integrate into your analysis the COT data. Now, the commitment of traders, this is what institutions and essentially the non-commercials, so the biggest speculators in the market are doing. So institutions that are in the market to speculate and to make profit, not because they have some other business interests in these markets. So if we look here, for example, at what was going on when the market was creating this manipulation, we can see here that their net positioning was actually decreasing on the JPY. So this means that essentially they were moving to the bearish side of the JPY. Now, what you have to keep in mind is that all currencies on the spot are traded against the USD. So actually what we're looking at here is JPY USD. And since net positions were decreasing on JPY USD, this means that actually institutions were longing USD JPY because they were moving to the bearish side of the JPY, which makes JPY weak, meaning that they're actually longing USD JPY because on the spot, every currency is traded against the USD. So in a situation like this, they were actually moving to the bullish side for USD JPY. So during this move to the downside, they were already moving to the bullish side of USD JPY. Now, this increases the probabilities that this would just be a manipulation because institutions are already adding their longs, and at that point, we would have a high probability of a potential rejection to the upside away from this manipulation area, because at that point, institutions have filled in their long orders. And in fact, after that, that is exactly what the market did. The market created a rejection away from the zone. Now, how we could take advantage of a situation like this, right? Because we covered what they are, what manipulations are, why the market is manipulated, how to spot when the market is in a manipulation that it is actually a manipulation. But the real question is how you could potentially take advantage of this. Well, as usual, my suggestion is to always rely more on multi-time frame analysis and not just looking at one specific time frame. The reason for which I say this is because if you are inside of a manipulation area like here, right, and you're only looking at the daily time frame, it's very difficult to actually time when exactly you're starting to have a shift back to a bullish market, because always remember that different time frames will have different trends. Like, for example, here on the daily, we clearly, let's say, for example, here, daily time frame, okay? So daily time frame, you have, for example, an uptrend like we have in a situation like this, right? Now, if here on the daily you're having a manipulation, which is exactly what we have here on this market, if you have a manipulation on the lower time frame, so let's take, for example, the 1 hour time frame, okay? On the 1 hour time frame, this move to the downside on the daily will actually look like a bearish trend, right? Because you go down on the lower time frame. So even though here on the daily time frame we have just this move to the downside, I guarantee you that this daily time frame here with just one red candle that clearly on the daily is a bullish trend, here this daily candle on the 1 hour time frame will look like a massive downtrend. So essentially, if you're going down on the 1 hour time frame to time your potential entry for a continuation higher, you will be able to see on the 1 hour time frame and on any lower time frame a shift from a bearish trend to a bullish trend. So essentially, you will have the possibility to see this shift back to a bullish market on the 1 hour time frame or lower, that at that point will create the continuation to the upside, because this is for sure, is not that I guarantee it, is that simply it works like this. If you have a daily time frame candle which is red, on lower time frame you must have a bearish trend. In fact, if we go down, for example, in daily time frame here, what we can see is that clearly we had a bearish trend, right? And the definition of a bearish trend is a market which is creating lower lows and lower highs, which is exactly what was happening here. Lower low, lower high, lower low, lower high. Now, in a situation like this, you know that the market is potentially creating a manipulation. Institutions are looking to the bullish side. You're already alert to the fact that we could see a shift back to the bullish market. So how you could potentially time your entry. Now, that pretty much depends from your own trading strategy, trading rules that you must backtest and develop suitable to your own trading style. However, let's take a very simple and generic example of execution method, so simply based on market structure, right? So here we can see that still we have a bearish market, right? However, what we start to see here is that the market is shifting from creating lower lows and lower highs to now creating higher highs and higher lows. So as you see the market creating higher highs and higher lows, you say, okay, institutions are longing. We know that we are in a manipulation area. We have a high probability of a move to the upside from here. So we could be looking, for example, just to do a generic example, on a retest of a previous 1 hour resistance turn support for a move to the upside away from the area. And what we can see, in fact, is that if you were looking for such execution method, you would be essentially able in a situation like this to potentially capitalize and anyway look to take advantage of the move to the upside away from the manipulation area with a high risk reward. Now, if you watched my other tutorials, you will see that most of the times I suggest to use at least a 1 to 3 risk to reward. I do not want to repeat yourself, so I suggest to go and check out my previous videos in the tutorial section to see why I recommend a minimum 1 to 3 risk to reward. But anyway, to develop any kind of trading strategy that you must develop for yourself, so to essentially if you're watching this video, probably you're looking to develop your own trading strategy and trading plan, you have to always remember to follow these 3 steps. First, backtest to create a strategy, then demo trade until you're consistent, and only at that point you can start thinking about going live, because these are just general concepts that I speak about here in these tutorials to give you more education so that you can potentially approach the markets with more knowledge. Now, if you want to learn more, I'd really suggest that you go and check out the transparentfxtrading.com website, which you find also linked in description. Here, you have the possibility to gain access to my entire courses with all the rules of the strategies. You also have the possibility to gain access to one-on-one private mentoring, the VIP market breakdowns with the Telegram signals, the CO2 data software, which is precisely the one that we used in this tutorial, tutorial, the trading station software, which puts together everything that you need as a trader all in one interface. And if you will continue to scroll down, you will see that you have the possibility to join directly from the website and gain automatically access with the email and password that you will create during the checkout process. So the link is also in the description at transparentfxtrading.com, and I will see you in it, and I suggest to go and check it out right now.
If you enjoyed the video, make sure to smash that like button and comment below. It really does support the creation of more free analysis education and updates for all of you, and I will see you in my next breakdown.